Why use futures contracts for commodity hedging? Imagine you're a farmer about to harvest wheat or a company that depends on oil for production. You face a big question. What if prices change before you sell or buy? Futures contracts can be part of the answer. They are agreements to buy or sell a specific amount of a commodity at a set price on a future date. These contracts are traded on organized exchanges, which makes them easy to buy and sell. This standardization means everyone knows what they are getting, and there is plenty of liquidity. Using futures for hedging helps manage the risk of price swings. If you're a farmer expecting to harvest wheat, you can sell futures contracts now to lock in a price. If the market price drops later, your futures contract will offset the lower cash price. Conversely, a food processing company might buy futures to lock in costs for ingredients like wheat or corn. This way, they avoid surprises if prices rise unexpectedly. Most futures contracts are closed out before the delivery date, so you don't have to physically deliver or receive the commodity. This makes futures a flexible tool for managing financial risk without logistics headaches. The contracts are standardized, meaning the quantity and quality are fixed, which simplifies the process. For example, a wheat futures contract might be 4,000 or 5,000 bushels, with delivery dates every month. This standard size and schedule make it easier to plan and hedge. Active futures markets also mean you can enter and exit positions quickly. If market conditions change, you can sell your contract before the delivery date. But it's important to consider basis risk, which is the difference between the futures price and the actual cash price. If these don't move in sync, your hedge might not be perfect. You want to choose futures contracts that closely match your physical commodity in quality, location, and timing. Producers like farmers or miners can lock in prices for their output by selling futures contracts. This guarantees revenue even if prices fall later. Companies that buy raw materials can purchase futures to fix their input costs, protecting profit margins. Traders and merchants use futures to hedge inventory or anticipated purchases, reducing the risk of price changes during storage or transit. Investors holding commodity assets can also use futures to protect their investments from sudden price drops. In short, futures contracts are a key part of commodity hedging because they offer a straightforward, liquid, and adaptable way to transfer price risk. They help producers, consumers, and investors plan with more certainty, making the overall market more stable.